Good morning, Brent Edwards, Brent the Broker here. Listen, I've been getting a lot of questions around the coronavirus, what it's doing to real estate prices, what it's doing to interest rates. I know that there's a lot of people out there who are concerned about the market, where it's going, what it's doing. Whether you own property, you're thinking about selling property, you're thinking about buying property. These are, very unprecedented times, kind of bizarre times. So I just want to dive into a few things here and try to give you just some good information from some experts that I really respect and follow, and see if we can't just give you some comfort and some just some good information, because I find that information and being prepared with what we might be up against tends to give people comfort. And so that's what we're going to try to do here. We're going to talk about the mortgage rates. We're going to talk about where we think the market is headed, what the impact of the coronavirus might be, and things of this nature, and see if we can't get you some good information. So hopefully we can go ahead and do that. Now, this graph that you're looking at here, it shows the symbiotic relationship between the 30-year mortgage rate and the 10-year treasury rate. A lot of folks have reached out and asked, since the Fed lowered the federal funds rate down to almost zero, a lot of people have been asking, how does this affect my mortgage? Can I get, a lower interest rate? And the fact of the matter is that the mortgage rate market doesn't tend to track the federal funds rate. It could be impacted by it in some other ways, but typically, as you can see for the last 50 years, it has typically followed in lockstep with the 10-year treasury rate. Now, it's interesting because recently we're not seeing that. What we're seeing more recently in the last few weeks is that they're actually going in opposite directions, or it's not following, one for one in lockstep. And the markets are behaving, the mortgage market is behaving very odd, and it's compared to its historical context. So we are not seeing, even though the 10-year treasury rate continues to plummet, we're not seeing a one-for-one, we're not seeing the mortgage rate follow it one-for-one, and a lot of people are wondering why. The deputy chief economist at First American says in this quote here that the spread, the difference between the mortgage rate and the 10-year note, is increasing because mortgage refinance application processing capacity cannot meet demand. So basically, there is so much demand for people refinancing with these historically low rates, and with the anticipation that rates are going to continue to get better. So a lot of people put in these applications. If you're at 3.75, if you're at 4, you might be excited to get down to 3.5, 3.25, 3. We saw rates in the high 2s for some loan products just a couple of weeks ago, and so there was this rush of applications, but the capacity that these lenders have to process these loans, quite frankly, it just can't keep up. So lender offered rates, as per this quote, lender offered rates don't follow the treasury yield down one for one. And so even though the mortgage rate declined, it says here it's unlikely to fall by the same magnitude as the treasury yield or the 10-year note. Now, it's interesting because the next paragraph says it's plausible that mortgage rates fall further if the benchmark 10-year treasury bond yields decline further. It's reasonable to expect that rates will fall even further and likely surpass the record low, but not necessarily one for one with the 10-year treasury yield. Now, when this happens, who knows? The people that I talk to seem to think that we're going to have to see some improvement on the statistics around the virus in order to see some improvement in rates. But here is the opinion of one person, the deputy chief economist at First American, along with some other of my lending partners who do think that the rates will fall further and they'll likely surpass the record lows that we've seen. But unfortunately, until the demand and capacity sort of levels off, we probably won't see that, and it may not necessarily go down one for one with 10-year treasury yield. So if you're thinking about refinancing, if you're in the process of refinancing, and you can't quite get the rate that you need in order to make it attractive just yet, hang in there, because there are people out there who do believe that this will correct itself, especially as they pump more liquidity into the mortgage markets. we should start to be able to see the capacity be able to meet the demand, and the 30-year mortgage rate should start to decline more in line with the 10-year treasury yield as we've historically seen. So as far as rates go, to keep it simple, you might have to hang in there to see rates decline further, but the experts that I follow seem to think that the rates will eventually continue to decline. So if you've got an application in, make sure that you're working with a good mortgage professional. I am not one, but if you need a referral for a solid mortgage professional, let me know. I work with a couple of really good ones, and we can make sure that you are in a position to pounce in the event that rates do get lower, which seems to be the expectation. Now, granted, with all this bizarre kind of things going on in the marketplace, no one can really predict it. No one can predict it ever. But the fact of the matter is, we take the information that we have today. As more information comes in, we'll continue to provide that to you. But for now, it sounds like, if you're purchasing a home now, probably lock in your rate because of the volatility. Check with your loan officer to see if they agree with that assessment. But if you are just looking to refinance, or you have some time to wait it out, taking a wait and see approach might be the best bet for you. Here is another graph that shows kind of what rates have been doing. So you can see around March 5th, rates hit record lows, 3.29 for a 30-year fixed rate on a conventional Freddie Mac loan. And you can see that that's well below where we were even in the second, third, and fourth quarter of 2018. You see, if you were buying or refinancing just a year and a half ago, rates were in the fours. We started to see them come down, kind of bottom out around the beginning of March. And then the coronavirus pandemic hit the United States, and it has caused some of the bizarre reactions that we've seen. And you can see over the last couple weeks, mortgage rates spiking back up. Now, this is not to give you the impression that this is where rates are today. The markets are always moving minute by minute, hour by hour. So in order to understand where your rates are at today, again, make sure you're working with a high quality mortgage professional that can walk you through these things and make sure that you're strategizing in a fashion that is best for your situation. But you can see the spike here that we discussed, and the experts seem to think that it's going to start trending lower at some point in lockstep with the 10-year treasury note. So that's kind of where we think rates are going in the short term. The next thing that people are wondering about is what's going to happen to the housing market. Are values going to drop? Are values going to go up? Like what's going to go on with our real estate assets here? And one thing that people fear is they see the stock market melting down, right? We see the stock market correcting in a pretty substantial fashion. Last time I looked, the S&P 500, which is sort of the benchmark for the U.S. stock market, is down close to 30%, maybe a little bit higher year to date. And that's a pretty steep drop, and it's got people worried about what that means for the housing market. Now, what you see here is the most recent recession from 2007 to 2009. Now, this was interesting because you can see the S&P from 2007 to 2009, the stock market went down about 51%, and you can see annual home price depreciation in the same time went down a little over 18%. So the interesting thing about that period of time is that there was a complete destruction of the financial markets, loose lending practices, people taking cash, doing cash out refinances, people being approved for loans that they have no business being approved for, stated income, false appraisals, like all kinds of craziness that went on structurally. And so the most recent recession around 2008 was driven by these issues in the housing market. So of course we did see depreciation in the housing market back then, but what we need to ask ourselves now is this current recession that we're in or embarking on, is it similar to 2008? The chief economist over at Gluskin Sheff and Associates, David Rosenberg, is a highly respected economist, and what he says is that 9/11, that what we're going through today with the coronavirus has more in common with 9/11 than 2008. And it says that what 9/11 has in common is that what's happening today is that this shock has generated fear and angst and anxiety amongst the general public. People avoided crowds because back then they believed there was going to be another terrorist attack. And they're acting the same way, to avoid getting sick and because of the controls that some of the governments have put in place. And the same parts of the economy are under pressure: airlines, leisure, hospitality, restaurants, consumer discretionary services in general. So if we agree with Mr. Rosenberg that today's environment is more like 9/11 than it is 2008, then let's take a look at what home prices did back during that correction. And so this will include the recession. This is the recession that included the dot-com and the 9/11 crash, so September 2000 to October of 2002. And you can see the S&P 500, the stock market, was down 45%. However, because this particular recession was driven by kind of external factors rather than internal issues with the housing financial sector itself, you can see what home prices actually appreciated across all 3 years, and cumulatively just about 23.7%. And this is on a national basis, so obviously everybody's localities will vary a little bit. But what we can see here is that if we agree that the current pandemic is more in common with this recession, 2000 to 2002, then theoretically we could see annual home prices actually appreciate through this recession if we agree that it's roughly the same type of thing with external stimuli causing people to freeze up. Now, another thing that we have to be very clear on is that a recession is defined as negative GDP growth for 2 consecutive quarters. So it's a slowdown in economic activity on the whole. Now, 2008, the housing crisis and the recession sort of went hand in hand. And so I think a lot of people still have, some scar tissue from that time. And they worry every time they hear this word recession that it's going to mean, it's going to impact housing values negatively. But a recession does not equal a housing crisis necessarily. Bill McBride, another respected economist, says, with the sudden economic stop and with many states shutting down schools, bars, and restaurants, my view is the U.S. economy is now in a recession and GDP will decline sharply in Q2, as Goldman Sachs is forecasting. The length of the recession will depend, of course, on the pandemic. So again, there seems to be this external stimuli that kind of brought on the current recession faster than maybe we had otherwise anticipated. Now, going and taking a look at what Goldman Sachs is forecasting, obviously this recession came to the United States kind of beginning of March, and now we're in the middle of March and things are getting really crazy. And you can see January and February, before the virus got here, things were okay, but you can see the end of Q1 will show a slight dip, and then Goldman is forecasting a pretty solid decline in Q2 as we try to get out in front of the virus and deal with the shutdowns and people not going to work and things of that nature. But look at what they're predicting for Q3 and Q4, and they are predicting further strong gains in early 2021. And so what this is showing us is that the people at Goldman Sachs believe that once we have some positive news on this pandemic front and the cases of the virus start, getting under control, maybe we have a cure, maybe we start getting some good news, whatever that might be, that we are going to come out of this recession sharply. And if we think about it logically, it makes sense, right? Like, we're all cooped up in our homes right now, and all we want to do is, go to a basketball game, right? Go to a baseball game, go to bars and restaurants, go to the grocery store. I mean, we are all cooped up. And so the minute that this blows over, and it will blow over, there's going to be this pent-up demand for people to go out and live their lives and start creating economic activity again. Now, granted, nobody knows what this pandemic is going to do. If it continues into the Q3, then this forecast might be adjusted. But I think what we're seeing here is, rather than a U-shaped graph where it's a long decline and a long recovery like we saw in 2008, what we're seeing is more of a V, where it's a sharp decline. And whether that's Q2, Q3, Q4, it's going to be a sharp decline. And then what people are predicting, the experts, what they're predicting is that we're going to come out of it sharply, because there doesn't seem to be a systemic damage to our economic system. It's an external thing that's driving it. So rather than the tornado that caused the havoc in 2008, where it destroyed infrastructure and we had to slowly rebuild from the ground up, this is more of like a major snowstorm where we're all shut in and economic activity slows down. But once the snow melts, we'll just go right back to kind of where we were, according to what the experts are saying. So this doesn't seem to be a structural damage to our financial system like it was in 2008. This is more like a major snowstorm, and as soon as the snow melts, whether that's in Q2, Q3, Q4, whenever it is, people should be able to resume their normal lives, go out to bars are going to open, restaurants are going to open, and things are going to get back on track kind of sharper and more quickly than it did in 2008. Wells Fargo tends to agree. We do not expect a repeat of severe recession because the virus and oil shocks are not endemic to the financial system, but rather external. Once the virus infection rate peaks, we expect recovery to gain momentum into the final quarter of the year and especially into 2021. So Goldman and Wells Fargo, these are the folks that are commenting on these things, and those are two pretty well-respected organizations. Nobody can predict everything perfectly, but I'm just trying to get you the information that we have from the people who have been doing this for a long time and do it for a living. Now let's talk about housing prices in the recession, because I think we're all pretty confident that there's going to be a recession. The duration of it, who knows? But let's look at housing prices during the last 5 recessions. You can see that 3 out of the last 5 recessions, housing prices actually went up. In 1991, they dipped a pretty nominal amount, about 2%. So 4 out of the last 5 recessions saw either gains or a minor dip in housing prices. Now, obviously, the outlier here is 2008, and that's because of the things that we discussed before, where there were systematic and endemic issues that went on here. But again, we don't think this is 2008. The experts that I follow don't think it's 2008. They think it's more in line with 2001. And 2001, home prices actually, did pretty well. The other thing that drove the depreciation of housing prices in 2008 was the number of foreclosures. So the question is, foreclosures and short sales, when people are walking away from their homes and the banks are auctioning the homes off, what we were finding is, A, there was such a massive influx of supply. 2, the banks had no idea what they were doing or what the values were. The banks are not in the business of owning real estate. They're in the business of money. So as the banks auctioned these things off or sold them in short sale, we saw a lot of activity in 2008, 9, 10, 11, where banks were accepting prices on these homes that were much lower than they probably even could have got at that time. And so the rise in number of foreclosures, the rise in number of short sales, the rise in bank-controlled sales will, A, cause an influx of supply, which decreases your value, and B, those folks just aren't in the business of real estate. They're not typically worried about top dollar as much as they are about getting the home off the books. Another thing that the government has learned, so we've all learned a lot, right? The United States as a people and the government as well learned a lot, where, the foreclosure crisis that happened in 2008 really participated and precipitated and fueled a lot of those declines, because again, with an influx of supply and the supply of homes that were being put on the market by banks who weren't so interested in getting top dollar as much as they were interested in cleaning up their books. Well, now it looks like the government has wised up to that, and they're going to get out ahead of it. The FHA, the Federal Housing Administration, indicated that it is enacting an immediately foreclosure and eviction moratorium for single-family homeowners with FHA insured mortgage for the next 60 days. The FHFA, the Federal Housing Finance Agency, announced it's directing Fannie Mae and Freddie Mac to suspend foreclosures for at least 60 days. So, excuse me, got a hair in my mouth. So what we're seeing here is that the government learned their lesson that, you know, sending a bunch of people to foreclosure and having an influx of supply is going to decimate the market. And they're already starting to get out ahead of that to make sure that, you know, people can stay in their homes and that there is sort of a safety net for this recovery. So that is a positive indicator of where home values are going to go, because if every other home on your block is getting foreclosed on or short sale and people are walking away, that's going to decimate values. But if the government puts a stop to those things and allows people to sort of recover from this and get back on track, a lot of people will be able to stay in their homes. There won't be the influx of supply, and that should stabilize housing prices for that time. So let's hope that these actions from the government continue, because it would be beneficial for the market. Another set of people that have wised up is the American people. You can see this is a chart of total home equity cashed out. You can see in the run up to the 2008 crash, people were using their homes as ATM machine. They were borrowing money left and right. A lot of the times they were using it to buy depreciating assets, cars, motorhomes, things of this nature, and you know, just mortgaging their homes to the nines. You can see $263 billion, $321 billion, and $240 billion in equity cashed out. So they're harvesting the equity out of their homes. And what happens is, if you're harvesting all the equity out of your homes and you're borrowing as much as you can, once the market dips like it did in 2008, you owe more on your home than it's worth. And so people were just walking away, foreclosures left and right, short sales, giving the keys back to the bank, whatever they could. People just didn't care because they had no equity there because they had spent it all. Now, contrast that to today, 2017, 18, and 19, 71 billion, 87 billion, and projected 74 billion for 2019 in total home equity cashed out. So you can see the difference in the total equity that's been cashed out. And if we look at the landscape, which unfortunately I don't have a slide for, but if we look at the landscape of the amount of equity that people have in this country, it's a lot higher equity position that most people are in. And people aren't just going to walk away from that. People are going to fight tooth and nail to keep their wealth that's accumulated in their homes intact, whereas before they just cashed it all out. So we as a society has seemed to have wised up to what happened. And so this is a really good sign as well for, are foreclosures going to increase? It's less likely that foreclosures are going to increase because we're seeing people with, in general, with a lot better equity positions than they were in 2008. Another thing that we can look at is the payment as a percentage of income. So because the job markets have been so strong and unemployment has been so low, what we're seeing is that the historical norm of 21% of your 21% of your income going towards housing is the historical norm. And what we're seeing today, it's down here at about 14.8. That means that people are in a much better position to afford the monthly payment. So as job losses happen and as businesses slow down, if your monthly housing payment is a smaller percentage of your budget, you're more likely to be able to sustain making that payment through a recession, through a tough economic time than we were. So we're better prepared from a equity position, and we seem to be better prepared as a society from a payment position as well. So this should be another thing that allows us to sort of stave off a foreclosure epidemic, so to speak. So this is a good sign for values as well, being at least sustained. And again, this is just another of the same slide that I showed you earlier. It's very important that we point out that the recession does not necessarily equal a housing crisis. A lot of the times we see values go up. And quite frankly, if we see the numbers for this virus improve or decimate, let's say they found a cure tomorrow in an extreme example, and we saw that the rates dip to historic lows as are being predicted by some of these economists, well, that could be a perfect storm for an influx of demand coming out of this thing. So I'm not sitting here saying that it's going to be easy. I'm not sitting here saying that everyone fits these exact models. But what I am trying to explain is that on the whole, what we're seeing today is much more 2001, 2000, 2002 2000, 2001, 2002 than it is 2008. And we have wised up as a society with regards to our habits around financing real estate, and we've wised up as a government to how we're going to handle a potential economic recession in housing. So with all that said, that's the information we're getting today. More and more information comes out on this stuff, seemingly by the minute. Things are always changing with regards to stimulus packages, sheltering in place. And I think there's a couple things, 2-3 things that we need to think about as leaders of our family, as members of our community. The number one goal right now is to keep yourself and your family safe and healthy, whether that means sheltering in place, whether it means, not going to work, listening to the experts around the virus and your local governments. Very important. That's the number one thing. Number two is we need to try to stay in a state of calm, survey the situation. One of my mentors, Tom Ferry, always talks about, are you a lion or are you a lamb? A lion surveys the landscape, they see what's going on, and they react accordingly. Whereas a lamb, if they hear a little rustle in the bushes, they run and hide, right? So we want to make sure that we are using logic in our decision making, that we're surveying the landscape, and that we're staying strong and calm for the people that count on us, for our community, because it's going to be a lot easier to work through this if we're working together and staying in a state of calm and helping each other out. And the third thing that I would say is that let's just try to be as kind as we can to one another. Let's try to find some generosity where we can. Fear and greed and anxiety and these type of things that tend to go on during crises like this can cause us to kind of clench on to whatever it is that we're after, whether it's like hanging on to our house or the new job or whatever it is. And if we can stay in a place of gratitude and a place of generosity, rather than holding on like this, what we can find is we can come and work together in a collaborative way. And, when it's a stormy time, you're going to catch a lot more rainwater like this than you are like this. So be good to one another. If you have any questions about, your real estate, your rental properties, mortgage, if you just need help getting groceries, if you need errands run, I want to be here for you as a source of information and hopefully inspiration, because we are going to get through this. And when we do, we need to be able to be prepared to serve those who count on us. So I hope everybody's staying safe and staying healthy. We'll continue to bring you as much information as we can around this stuff. And, I hope everybody is weathering the storm. Talk to you soon.